Good morning, everyone. Good morning, everyone. Welcome to this session on taxation. Um, I noticed that we have some uncompleted business from the previous session, so we'll do that as well. And then we will also do what I had planned for this session. So great, happy to be here. Excited to meet all of you again. I'm hoping I'm going to start off because we are already at 9, and we have a 2 hour session. But I hope more students join because this session is very critical to a lot of commercial and business practices that go on in all our lives. So, whatever capacities we are in. As usual, can I just make sure that people can see me and more importantly, hear me? So, if somebody on the chat box can just say that, that'll be great. Um, and then I can start. Great. Thank you, Indu. All right. So um, what are we doing this session, right? And this session is I'm hoping although there's a lot of stuff that's important in terms of statutory law. I'm hoping that this is a more relaxed session because uh, I want to have a more open-ended discussion with you. Most of the time, we end up working through some problems, some tax issue or the other. While we will do that at the beginning of this session, I want to then open up the discussion and talk about various forms in which we do business. And that brings me to what is the primary element of what I'm trying to do in this session, which is that I'm asking you, or all of us asking each other, what kind of business forms um, are relevant for tax law and in what way, right? So we have corporations, we have trusts, we have partnerships, we have a hybrid entity called limited liability partnership now. And a question that we need to ask ourselves is, as smart businessmen and people who are interested in commerce, now, in what way are these business forms relevant for tax law? And why is that important? Why is that discussion important? Right. So that's what I want to discuss. I think this is this won't be like our other tax classes where we do a lot of problems. Although we will solve one problem here before one case before we go forward. But after that, I want the discussion to be a little more commerce oriented, or a little more oriented towards why we're doing some business, and what are the tax implications of that. Okay, so we'll start off on that. Now, what we had some unfinished business from the previous session, and that will give me an opportunity to actually review what we have done in that session, because that session was quite important and also complicated. And then we'll continue with what I would like to discuss today. Okay, so now I'm just going to share my screen, and then we'll start off. Yeah. Okay. Okay. I'm hoping that all of you are able to see the screen. Just could you just let me know in the chat that you have the screen on your laptops and computers? Excellent. Yeah. All right. Yeah. Okay. So we are in this session, we are continuing our discussion on corporate taxation, and we will then segue into taxation of trusts and partnerships. And what we want to do is we want to ask ourselves this question, which is, what kind of business form is appropriate for taxation? Right? That's what we are trying to ask, and the implications of that choosing one form or the other. Yeah. So that's what we're trying to do. Just give me 1 second, please. Yeah. Yes. So we in the previous session we asked when is corporate income taxed? And the answer was that it is taxed twice when it is earned and when it is distributed to the shareholders. And today we're going to learn that for trusts and partnerships, unlike for corporations, there is only one level of taxation. Now, these are the three basic points that's mandate for this session. But around these three basic points, we have got a host of complicated, somewhat abstruse statutory provisions, and some of that we had discussed in the previous class as well. Just to give you an overview, when a corporation earns income, there are various ways in which the corporation can transfer that income back to its shareholders. The problem is that all of these various ways have some tax implication or the other, right? And we discussed that in our class last week, 2 weeks ago. We said the easiest way for the corporation to distribute income is to distribute a dividend, right? And earlier, the dividend was being taxed under Section 115 Clause O, read with Section 115 BBDA. It was being under Section 115 Clause O. It was being taxed as the corporation was giving out the dividends. So it was called the dividend distribution tax, and there was a dividend distribution tax as the money went out of the corporation. And now, under the new regime, um, uh, we don't have to worry about what happens when the money is leaving the corporation. What we need to worry about is what happens when the shareholder receives the money. When the shareholder receives the money, the shareholder is now taxed on those dividends at whatever slab rates he's under. He may be a wealthy shareholder, in which case he's under the under the 30% slab rate. So it depends really on what kind of income the shareholder is earning, right? But that's dividends is just the easiest way to transfer money is to give money to the shareholder, and what I described to you just now is that kind of regime. But there are other ways of giving money back to the shareholder, right? And the other way was to do a buyback of shares. Again, there was an old regime and there's a new regime now. In the old regime, there was a certain flat rate of tax when the again on the corporation when the corporation bought back shares from the shareholder, and I'd given you a list of sections there. Under the new regime, under Section 2, Clause 22, Clause F, read with Section 46A, there is a tax, but the tax, once again, much like dividends, is in the hands of the shareholder when the shareholder receives the money, when the company buys back the shares. And a part of it, depending on the circumstances that the shareholder is in, of course, it'll be taxed at the slab rate that the shareholder is. And the shareholder will receive a certain sum of money as income from other sources as dividend under Section 2, Clause 22F. But under 46A, there will be a deemed capital loss for the shareholder that the shareholder can take forward. If the company is liquidated and money is sent back, once again, it is deemed to be a dividend under Section 2, Clause 22, Clause C. And what if there's any, if there is, in addition to that dividend, if there's any return of capital, it will be taxed under Section 46 as capital gains if there is any money. Of course, in doing that, in Section 46 takes into account the fact that a part of the money has already been taxed as dividend. If bonus shares are issued, then if the person owns equity shares and bonus shares are issued of equity, there is no tax consequence, as you have read in the cases under income from other sources, and only if preference shares are issued will there be a tax under Section 22, but that's a different kind of taxation. Usually, for issuance of bonus shares, there won't be any tax. Uh, we've seen that under some cases under Section 56 that I think we had referred to earlier. But Section 2, Clause 22 talks about bonus shares, but only in a very limited context. It says that um, um, if you go to section 2 clause in the definitional section, section 2 clause 22e, there is a reference to bonus shares, but that's only with reference to preference shareholders. That's regarding bonus shares. Then there is a question about reduction of capital if money is returned back to the shareholders because of return of capital. Then in that case, under Section 2, Clause 22D, there is a tax on that return of capital that is again taxed as a deemed dividend. And then there is the final element that we were talking about, which is loan advances to shareholders, Section 2, Clause 22E. And I had mentioned what problems would arise if the company provides loans to its shareholders. And we had some, I remember we had some discussion about it, and we'll come back to this point in today's session. And then I had said that if the company gifts its shareholders, then the company will be taxed under 56(2) clause X, which is income from other sources, when the gifts are provided to the company. If you could just give me 1 second, I just want to find that provision 22, section 2, clause 22 that talks about these things in more detail. Just give me 1 second, please. Yes, so section 22, clause B says, section 2, clause 22, clause B says any distribution to its shareholders by a company, any distributions to its preference shareholders of shares by way of bonus to the extent to which the company possesses accumulated profits would be considered as deemed dividend, but this is only a bonus distribution to the preference shareholders, not to the equity shareholders, right? If it's equity shareholders, there will not be any tax. Now that's so these are the different ways in which a company can return money. What's fascinating about this, if you notice, my friends, that we have so many different sections with Section 2, Clause 22 at the heart of it, which are there because shareholders over the past have devised various ways of trying to extract money out of the company without paying an additional tax. And their logic being that the company has already paid tax on this income, and why should we then again pay tax when the company is returning that income to us in some way or the other? And then this whole conspectus of tax that we are going through, dividend distribution, buyback, liquidation, bonus shares for preference shareholders, reduction of capital, this whole construction of return that we are trying to go back to, it is a reaction to the shareholders trying to find some way or the other to extract money out of the company without paying tax. So that's where we are. And then we had then, I think, stopped at the stage where we were talking about loan advances to shareholders and what problems would arise if the company provided loans to its shareholders. And I had given you a problem to solve. Um, and maybe I should give you, because this is again, it's been 2 weeks, so I don't know whether you've had some time to absorb it. So maybe I should give you maybe I should give you 5 minutes, right? Take a look at this problem and take a look at 2 clause 22 clause E and think about how you will solve this problem. I know we have done it, or at least we have started on this in last week, but many of you may not remember it. So and I don't want to rush into it. So I'll give you 5 minutes. Just take a look at, don't Google and stuff. Just take a look at this problem and take a look at 2 clause 22 clause E and tell me what your thoughts are. We'll discuss it. I know we have started on this already, so you don't need more than 5 minutes to, I think, to come to grips with what's happening here, and then we'll come back and I'll talk to you about it a bit more. Yeah. So 5 minutes, please. Okay, I'm back, and um, I hope that you had some time to think about it. And if any of you want to talk, I'll just read out the facts once more. And if any of you want to jump in and talk, and or you want to um, comment, please do so. Let me read out the facts first. The facts are that the shareholding pattern of company one is as follows. Shareholder A owns 45.1%, shareholder B holds 45.1%, shareholder C holds 9.8%. The shareholding pattern of company 2 is as follows. Shareholder and the same shareholder A owns 43.19%, shareholder B holds 26.46%, shareholder D owns 30.35%. You can see that A and B are common shareholders, and between them, A and B hold more than 50% of the company, of both the companies, of company one and company two. Sorry, just give me a second. Um, So I'll repeat this for you. Shareholder company pattern of company one is as follows. Shareholder A owns 45.1%, shareholder B holds 45.1%, shareholder C holds 9.8%. The shareholding pattern of company two is as follows. Shareholder A owns 43.19%, shareholder B holds 26.46%, shareholder D owns 30.35%. As can be seen, as I repeated before, A and B are the common shareholders, and they own more than 50% of both company one and company two. Why am I going into these facts in this kind of great detail? Because that's how it is. A lot of companies are very closely held, and promoters have kind of cross holdings in companies. It's not an uncommon thing. Company two then gives a loan to company one. Has company one received dividends under the ITA? Right now, first question I have for you is that if you go back to the previous slide, and before that, let me just see if somebody has raised their hand, or have they want to talk. Just give me a second, please. Yeah, I see there are many participants here, but I don't think anybody has yet raised their hand or commented. I know that I remember some comments in the previous session, so I think we'll just continue off on that. Now, my first question to the class, think about this. I don't know whether, I don't think we actually talked about this in any kind of great detail in the previous session, is why are loans from companies to their shareholders being targeted at all? I mean, why is there a provision in the Income Tax Act under deemed dividends which makes loans, a certain kind of loans, as deemed dividends? Why is that? Why are we concerned about loans at all? Like, why? I mean, if you give a loan, you give a loan. Why should it be converted into dividends? I'm not sure why that's the case. So let's first talk about that. Who wants to say something about it? The question is not, it's not related to statutory provisions per se. I'm just asking, if I give a loan to if I'm a company and I'm giving a loan to my shareholder, why is the Income Tax Act bothered about it? Why should it make it into a deemed dividend? That's my question. Right? Who's going to answer that? I mean, you don't need to know any prior knowledge for it. Just tell me, what does the instinct say? Like, what, you're a smart businessman. Why would you agree with the Income Tax Act doing something like this? Surely some of you have something to say about this. Yeah, so Indu is saying that loan is income earning activity, hence taxed. Not sure what you meant by that, Indu, when you say loan is income earning activity. Suppose a bank gives me a loan, I'm not taxed on the loan. That's just some capital been given to me, and I have to. Well, the reason I'm not being taxed is I'm not really earning anything. I've received money, and remember that the money that I've received is not even, I won't even term it as some kind of an unqualified economic benefit. Because whatever money I have received, I have to return it back at some point of time. It's a liability in my accounts, right? And so that loan is liability for me. There's no reason why that ought to be taxed at all. So why is income tax act bother about loans? That's what I want to ask. Yeah, who else wants to take a shot at this? Yeah, because this is the kind of stuff that, I mean, you can learn tax elsewhere, right? But this is the kind of stuff that you must think about. Yeah, yeah. Sorry,
So
somebody was going to say.
subsequently, it can get converted. This is Asha sir here.
Ah, yes, Ash.
Subsequently, it can get converted into capital.
Sorry, but what did you mean by that?
That this loan is presently a loan.
Hmm.
Suppose they are not in position to repay the loan for any reasons. I'm for the worst things that we can think of. They can convert this into capital
You mean if the shareholder?
or debentures, which can. I mean, they can convert that into a capital and say that.
Hmm.
Uh,
No,
uh, hmm.
suppose I owe somebody owes. Suppose my shareholder owes money to me, which is what's the case here, right? I'm giving a loan to a shareholder. I'm a company. I'm giving a loan to a shareholder. This means the shareholder is my debtor. I'm the creditor. The company is the creditor. Shareholder is a debtor. Um, at that point of time, if the shareholder is not able to return the money back to the company will not really gain anything by converting that debt into a share, right? So economically speaking, the company will not be able to gain anything. So here's my answer but Asha, you're going on the right path in some ways. I'll tell you why. Because you are already assuming, and that's a good assumption, that this shareholder to whom the loan is made is unlikely to return the money back, which is actually a good assumption. That's the kind of assumption that the government is also making. What the government is thinking is this: in some circumstances, when the company wants to return money to the shareholder without paying tax, one way to do it is to give that shareholder an interest free loan with really no due date of return, right? And if companies start doing that, they can actually take money out of their coffers and give it to their shareholders without an additional level of tax. This is why the government is concerned and they want to do a deeming fiction. Now, of course, when you start doing deeming fictions like the sort I just now said to you run into some problems, which is you could be quite unfair uh, to shareholders because it could be that sometimes this is being done in kind of genuine circumstances. And therefore, the government has said that we will call this a deemed dividend, but we will call it a deemed dividend under very constrained circumstances. And I'll just tell you what those circumstances are. Let's go. All of you should now have the act in front of you, please. Either you have the act in front of you online or you have the act in front of you as a hard copy, right? But you need to have the act in front of you because from time to time we'll be going through some statutory provisions. So if you go to 2 clause 22E, you will see, just give me a second. Yeah. If you go to 2 clause 22E, you will see the definition of deemed dividends, loan as deemed dividend. It says any payment by a company not being a company in which the public are substantially interested. So this is the first limitation. this deemed loan doesn't apply, deemed dividend doesn't treatment to a loan doesn't apply to all companies. It only applies to payments by a company which is not a company in which a public are substantially interested, and that these are that in other words these are private companies. The companies in which the public is not substantially interested are private companies. That's and therefore you can see these don't apply to public companies. Not being a company in which the public, so in other words, companies which are privately owned and therefore controlled, not being a company in which the public are substantially interested of any sum, and then there could be any money, by way of advance or loan to a shareholder. This is the second limitation, which is being a person who is the beneficial owner of shares, not preference shares, but equity shares, holding not less than 10%. This, as I said, this is a limitation. They should at least hold 10%. So they have some control. Holding not less than 10% of the voting power. And now comes another complication, or to any concern in which such shareholder is a member or a partner and in which he has a substantial interest. Substantial interest has not been defined here, but substantial interest. So if the company gives some money loan to a shareholder, who owns 10%, or to a company or a concern in which the shareholder is has a substantial interest, then it'll be considered as a deemed dividend. What is a substantial interest? You notice if you go further down, you will notice in section 2, clause 22, same section, if you see explanation 3, for the purposes of this clause, a concern means a Hindu undivided family or a firm or an association of persons or a body of individuals or a company. And then it says, clause B, a person shall be deemed to have a substantial interest in a concern other than a company if he is at any time during the previous year beneficially entitled to not less than 20% of the income of such concern. Of course, clause B, if you notice, is talking about a substantial interest in a concern other than a company. And then it talks about 20% income. What if it's a company? Then how do we know whether a person has a substantial interest in a company? Anyone? How do we know? See, because this section and even the example we are dealing with are talking about raises the question, when does somebody have a substantial interest in a company? Right? Because the examples given to you involve two companies. So, yeah, Hindu's absolutely right, shareholder person, but Hindu, where do I get that from? Where do I get that information from? Yes, substantial interest is defined in terms of shareholding percentage, which is absolutely right, Hindu. But any idea where? Because this clause B doesn't cover that. So, where do you think it might be there? And the reason I'm asking this question to the class, it's an unfair question to ask in a way because all of us have to deal with the madness of the Income Tax Act. For some reason, they have not put that definition here. No, I don't think there's any logical reason for it. For some reason, they've not put it here, and they put it somewhere else in the definition section. So if you go to section 2, clause, I think if I remember right, clause 32, 2 clause 32, which actually defines a person who has a substantial interest in the company in relation to a company means a person who is the beneficial owner of shares, not being shares entitled to a fixed rate of dividend, whether with or without a right to participate in profits, carrying not less than 20% of the voting power. Right? So 20% of the voting power, it roughly, it actually tracks what was said for concerns other than companies. And so there we are, right? Now, in the facts of our case, if you take a look at it, what happened was that, and we'll just go back to our screen. In the facts of our case, the shareholding pattern of company one is as follows: shareholder A owns 45.1%, shareholder B owns this, shareholder C owns that, and then uh, similar shareholding, and then company two gives a loan to company one. Has company one received dividends under the ITA? And the question is very specific. The question is not whether shareholder A and B have received dividend under the ITA, but whether the company one has received dividends under the ITA. And my friends, what did we say about this last time? What did we say? Think about it, please. I know that you've already taken a look at this section and the facts. So what did we say? Please, someone. After you look at 2 clause 22 clause E and you look at the facts of our case, has company 1 received a dividend from company 2? Right? That's the question we are asking. And what might be your answer? And we have already gone through this whole idea about who's a substantial shareholder, substantial interest, and things of that sort. So we already done that. Yes, please. Yeah, so Indu has, thank you, Indu, and I hope other people jump in as well. I see there are 8 participants or 6 participants, so maybe we should have some other people as well. Indu, thank you. So you said yes, because A and B have substantial interest in both 1 and 2. Absolutely right. But Indu, here's the problem. The problem is that the question is asking, if you go back to the question is asking, and this is what the income tax authorities are doing. They are saying the income tax authorities are claiming that it is company one that has received dividends under the ITA. Suppose the income tax authorities have said, look, under the ITA, section 2 clause 22 clause E, shareholder A and B can be held liable for the loan, right? Um, and saying proportionately, then I understand. But how can company one be held liable? That's not the case. See, I can understand shareholder A, the income tax authorities can say that when company two gave a loan to company one, it is as if company two has given a deemed dividend to shareholder A or shareholder B because they own both. Of course, the dividend is coming out. They are shareholders in company two, but they also own a substantial amount of shares in company one, and therefore, when company two gives a loan to company one, it is as if they are receiving a deemed dividend under 2 clause 22 clause E. But that's not the case here. In this case, the tax authorities are not going behind shareholder A or shareholder B, they're going behind company one, right? And I'm curious, how can they do that? Because company one is not covered. Company one is not a shareholder of company two, right? Company one and company two have common shareholders, but company one is not a shareholder of company two. And this rule, on the face of it, 2 clause 22 clause E, appears to apply really only to loans provided by a company to its shareholder, right? So, what isn't that an interesting thing? What do you think? What do you think will happen here, right? So, Indu, have you changed your mind? Do you really think that company one can be taxed here? Or Asha, what do you think? Only company one can be taxed here? I mean, can company one be taxed here at all? The answer really, and we'll see the answer. Let's now go back to our facts, and we'll see what the answer is. And this is the case of Commission of Income Tax versus Anki Tech. And the facts are that during the assessment proceedings, the AO noticed that Ankitech APL had received advances of a certain amount from JGPL. And APL and JGPL are your company one and company two, right? And if you notice, company shareholding pattern was in APL, the major shareholders are Mahesh Kumar, Rukmani Gupta, and Manmohan Gupta. In JGPL, the shareholding pattern was Mahesh Kumar, Rukmani Gupta, and others. Now, assessing officer's contention was that since Mahesh Kumar Gupta and Rukmini Gupta held substantial interest in both JGPL, that is the company providing the loan, and APL, which was a recipient company, the amount received by APL as advances from JGPL should be treated as deemed dividend under Section 2, Clause 22, Clause E of the Act, and added to APL's income. And so the question was whether loans or advances from closely held companies to entities not directly holding shares, but in which shareholders with significant interest in the lending company also have an interest, can be taxed as dividends in the hands of the recipient entity. Right? And the court reasoned that while the conditions stipulated in Section 2, Clause 22, Clause E for treating the loan and advance as deemed dividends were established, the deemed dividend must be taxed in the hands of the shareholder, who has the requisite voting power in the company providing the loan and a substantial interest in the concern receiving it. It will not be taxed in the hands of a recipient concern that is not a shareholder of the lending company. So the legal fiction created by Section 2, Clause 22, Clause E expands the definition of dividends, but does not create a deemed shareholder out of the recipient concern. And therefore, the decision went in favor of the assessee. Right now, here's my question for the class, which is, um, okay, do you agree with this decision? I've got two questions for you. Right. First question: do you agree with this decision? That's the first question. And the second question is, why do you think the revenue was going behind the company, behind APL, rather than going behind the shareholders? So I got two questions for you. I want you to think about it for 5 minutes and I'm going to come back. First question, and you had an answer to me, and preferably some other people as well, not just Indu. I would like to hear from others as well. Two very simple questions. You don't need to have any prior knowledge. We just need to think about it carefully. First question is: do you agree with the decision of the court? And the second question is: why did the revenue choose to go behind APL rather than go behind the common shareholders? All right, so I'll give you 5 minutes. When we are back, I need an answer to both these questions. Thank you. Yes, I'm back. And who's going to answer my question? Let's see. Yes, please. Here's some answers. Let's see. Indu has said shareholders of closely held companies should not be withdrawing company profits in the form of loans and thereby avoiding dividend taxes. Yes, Indu, that's absolutely right, and that's why we have this provision. But my question remains, which is, do you agree with the decision or not? Is there somebody who agrees, disagrees with this decision? Do you think the logic of the court is right? That was my first question. So anyone on that? You've seen the decision. The decision is also available for you in your reading materials, which I hope you all of you have in front of you. It's important that you also refer to the reading materials carefully, and it's available to you there. It's reading in my it's note 32, Commission of Income Tax versus Ankitech Private Limited, Delhi High Court decision. Same, the facts are what was presented to you. The court, I think the court was making the claim that, look, this is a deeming provision, and because it's a deeming provision, we must be very careful in how we go about applying these kind of deeming provisions, right? And and so what we are doing is we should confine the deeming provisions to exactly what the deeming provision is supposed to do. The deeming provisions are catching the shareholders, as Indu rightly put it. The deeming provisions are aimed at the shareholders of closely held companies. They're not aimed at the companies themselves, right? So if you have company one, company two, they have a similar shareholding, and company one is giving company two some money. You can't go after company two. You got to go after the shareholders. So that's what they were trying to say. But here's my that was just the first question that I asked. I thought I asked you another in my mind interesting question, which is, why did the revenue do this? Why couldn't the revenue just go behind the shareholders? Why did they go and try to catch company two when company one gave a loan to company two? Why did the revenue decide that they have to go behind company two rather than going behind the shareholders? I want an answer to that question. Anybody has a thought on that, please? So where are we here today? We have got Asha, Dargesh, Henry, Indu, and Vivek. Vivek, you're not online? I thought you were online as well. So there are six people I can see. Surely one of you has some thought on this. This is not a purely it is not a tax question at all in some ways, right? It's a question that's got to do with why did the revenue adopt the strategy that it adopted? Yeah, and it's an interesting question. I think it's from the point of view of tax administration and tax law. This is an interesting question. So yes, anyone? What was the thought? What was the revenue trying to do? Right? And I don't have an answer to this. This is I can only speculate, right? Because that answer, I mean, really, only the revenue knows why it did. But let me speculate, right? I think the reason why the revenue did what it did is because the revenue is mainly interested in trying to tax at a stage where it has access to the cash, right? So Indu is kind of alluding to that a little bit. She's saying because the money is made by the company originally. I would put it a little bit differently. I'll say because, although I mean, Indu is right, but I'll just put it differently. I'll say it's because the money is right now in the hands of the company, right? So if company one is giving a loan to company two, that money that is the subject matter of the loan is in the hands of company two, right? And so the most administratively easy thing to do is to catch and tax in the hands of that company in which the money is, right? If you're going to wait and try to go after taxpayers who are behind the company, it may, first of all, they may not have the money. And secondly, it may take more time. This is the easiest way to do it, which is to attach that money that's coming out of company one to company two, and catch it in the hands of the recipient, right? And so catching them, so basically trying to tax the money that's in the hands of the recipient. This is why the revenue tries all these strategies. Revenue sometimes says, in the past, they have introduced the dividend distribution tax, where they're trying to tax money as it goes out of the company. Similarly, now they're saying dividend tax has to be taxed in the hands of the shareholder, the recipient. They're always worried about how to tax, because there may not be money anywhere. So they're always trying to catch the recipient of the money and trying to tax the recipient. And so that's what they were trying to do here. But unfortunately, they couldn't succeed because the law, the deeming provision is not in their favor. Now, if you go to the decision itself, I just want to refer you to the decision, note 32, Commission of Income Tax versus Anki Tech. All of you should read the case. I mean, one of the reasons why this tax course will be different for you, and it's important for us as well, is that we are not only discussing tax strategies or just the outlines of tax law or even the outlines of tax provisions. We are asking you to read the cases themselves, and you will benefit, right? Um, Now, I just want to read the last three paragraphs because that's relevant to the discussion that we are having. It is an admitted case that under normal circumstances, such a loan or advance given to the shareholders or to a concern would not qualify as dividend. It has been made so by legal fiction created under Section 2, Clause 22E of the Act. We have to keep in mind that this legal provision relates to dividend. Thus, by a deeming provision, it is the definition of dividend which is enlarged. When we keep in mind this aspect, the conclusion would be obvious. Loans or advances given under the conditions specified under Section 2, Clause 22E of the Act would also be treated as dividend. The fiction has to stop here and is not to be extended further for broadening the concept of shareholders by way of legal fiction. It is a common case that any company is supposed to distribute the profits in the form of dividend to its shareholders' members, and such dividend cannot be given to non members. The second category specified under Section 2, Clause 22E of the Act, that is, a concern like the SSC here, which is given the loan or advance, is admittedly not a shareholder or a member of the payer company. Therefore, under no circumstance, it would be treated as shareholder or member receiving dividend. If the intention of the legislature was to tax such, I'm just going back to, if the intention of the legislature was to tax such loan or advance as deemed dividend in the hands of the deeming shareholder, then the legislature would have inserted deeming provisions in respect of the shareholders as well. That has not happened. Most of the arguments of the learned counsels for the revenue would stand answered once we look into the matter from this perspective. The revenue wants the deeming provision to be extended, which is illogical, and the attempt is to create a real legal fiction which is not created by the legislature. We say at the cost of the repetition that the definition of shareholder is not enlarged by any fiction. So, before we part with, some comments are to be necessarily made by us. As pointed above, it is not in dispute that the conditions stipulated in Section 2, Clause 22E of the Act treating the loan and advance as deemed dividend are established in these cases. Therefore, it will always be open to the revenue to take corrective action by treating this dividend income at the hands of the shareholder and to tax them accordingly. As otherwise, it would amount to escapement of tax in the hands of the shareholders. So the court is telling the revenue, you can go behind, A, B, and C. You can go behind the shareholders, Mahesh Kumar Gupta, Rukmini Gupta, etc. But what you can't do is go behind the company, right? So that is what the court was trying to say. And one of the reasons why I asked you this question is because I was curious as to whether there would be that's why the revenue even did what it did. Let me just stop sharing. and come back to the class. Um, so this is what I was trying to say there, which is that there is a very interesting deemed fiction available in 2 clause 22 clause E, but the contours of that deemed fictions are still controversial. The courts have tended to interpret Section 2, Clause 22, Clause E quite strictly. And so, in conditions like this, in the examples that I was giving you, where one company gives a loan to another company and they have common shareholdings, the courts have not allowed the revenue to go behind the companies, but to go and tax the shareholders. But the revenue may not be very happy with this because the revenue would like to tax where the cash is, and catch that and try to tax that amount. But right now, as it stands, it's being prevented from doing so because of the strict interpretation that we just now saw in this case. Okay, so now this concludes one part of our mandate today, which is we took a close look at income from corporations and how that kind of income can be taxed because people trying to extract money in different ways: loans, dividends, return of capital, share buybacks, gifts, and all of those kind of liquidations. So all of those kind of strategies are being kind of addressed in different ways by our legislature. So that concludes one part of our mandate, which is a very close look at taxation, double taxation at the corporate level, and what are the issues and problems we're facing. But I want to talk today more generally about forms and business forms and how different tax consequences attached to different business forms. I will do that after the break. We'll take a 10-minute break now, and then we'll come back, and then we will do that. And of course, yes, somebody had a question. Yes, who's that?
Sir,
Please.
Asha here.
Yes, Asha. Yes, sir. Please
Sir,
go ahead.
may I mean, in the sense, this is beyond what you're teaching.
Yes.
They have scrapped the results of FA.
Hmm.
So now that they're going to conduct
Sorry.
only S.
Sorry. They've scrapped the result of the formative assessment, is what I've been told.
Yes, yes,
Yes. Yes.
yes.
Yes. Yes. Yes. Yes.
Uh,
Yeah.
and they are going to take only consider the marks only of a summative assessment.
Yes.
So and summative assessment is 100% written examination.
Yes.
So yeah, so will they be keeping the percentage of marks for passing at the same level as originally decided? Because earlier it
Hmm.
was formative assessment plus summative assessment, where there was a
Hmm.
bigger scope for getting scoring more in the formative assessment. And
Hmm.
in summative assessment, writing, all of us are not very young. I mean, it's some time back that we have all left writing. So we have
Hmm.
to get into it. That is a different thing. But
Hmm.
scoring there will not be that easy as much as in formative assessment, sir. So how
Hmm.
will they reduce the percentage of marks for passing?
I actually have no information on that. I don't think that'll happen. I think that we'll have the same percentage, but I'm really that's not something that I am any control over. You'll have to ask them. Can I just say something though in response to your earlier point, which is that I mean I don't have privy to all the kind of emails and all this stuff going around here between students and the administration, but I do know that there is no need to worry about this. You anyway, there are 2 points that you need to remember, and I think that will allay your concerns and your anxiety a little bit. First thing is that in any case, everybody had to do the summative assessment and had to get a certain percentage in it. What's happening now is that that is the only exam that is in play and not the formative assessment. So that's the first point I wanted to make. The second point I wanted to make is we should not there may be some reason why the formative assessments were, I mean, there's a substantial reason why the formative assessments were being not considered. But we should not look at the past. We should look at what we need to do now. Now, what we need to do is take into account how we look at the summative assessment. And on that, if you have just come to the classes and you're prepared, this course, I can't speak for other courses, but this course, you will not have a problem because it's just based on what we discuss here and the materials we ask you to read. So I mean that's all I can say at this moment of time. Sorry, Asha, I can't say more than that. Don't worry about it. Yeah, I mean, I think summative assessment anyway you had to do, right? It's only a question now that that seems to be the only assessment and not formative assessment. Though that,
If I
yes,
if I put it in a very simple way, sir, formative assessment, there is a bigger scope to score more. See, the percentage of marks that you need to make up for passing, minimum passing percentage
yeah,
in summative assessment would have been comparatively lesser had you scored more in the formative assessment. So,
yes,
balancing both, we would have got the sufficient scores required for passing. I'm not talking of passing and all that. I mean, it's too, I'm going down when I'm assessing myself when I'm talking of passing again. But then, sir, we all look at it in a different way. Maybe we'll try to enhance our knowledge after the course is over. But then for examination purpose,
yes.
we are looking at passing only. Let me be very frank,
Yeah,
sir.
I no, no, I understand your concerns, and I'll note down what you just now said, and I'll report that back to the PACE authorities. That's all I can do. I'll do that.
Please, sir.
I see. I
Please.
see. I noted down what you're saying, so
Yeah.
I'll pass that on to
Because
the PACE authority.
there is a fear in us because we need to be writing a lot.
Don't fear. Don't fear. Don't be anxious on that account. Is what I'm saying. But yeah, no, no. I noted what you said. Yeah.
Okay, sir. Thank you.
Okay. Thank you. We'll be back in about 10 minutes. Thank you. Okay, I'm back. I noticed that when I was gone, there was some other discussions about questions and assessments. We're not going to discuss that here, but in the chat box I've seen this, and I'll make note of this as well, right? So let me just summarize what your concerns are, and I will take those concerns to pace. And as I said, that's all I can do at this point of time. I'll two kinds of concerns. One is objective versus subjective. Objective, you could score more in the past, and subjective is harder to score. What do we do about that? And second, whether the subjective pattern also can be looked at, and what can we do about that? So this I will take it to the PACE department. I have one general comment though, and that's all we can do at this point of time. I don't want to have this as the major point of discussion in our classes. But I have one general comment though. I don't understand. Um, I'm not even able to grasp what it means to have some simpler pattern and more complicated pattern. You should not, as a general rule, when you're going, especially at NLS, right? You are at the National Law School now. As a general rule, when you're writing exams, you are writing exams in relation to questions that test you on your ability and your experience in grasping the concepts we have taught you. That's what we are trying to do. So this kind of simpler, more complex, it doesn't really help. What's important is that we are testing you at a level that we think you ought to be tested at when you're writing an exam of this sort, when you're doing some course of this sort. When we do that, at least, and I can't speak for others, but I can speak for what I do, we take into account what is the best and fairest way of assessing you. That of course we take into account what, and that will include things like what I have taught you, what course materials I have given you, and the level of difficulty I expect from someone who is not a lawyer, who may or may not be a lawyer. I know there are some lawyers here, but there may not be any, there may be people here who are not lawyers, who may or may not be familiar with the kind of law that we teach. We will take all of those things into account when, and I do it. I can't speak for others, but I'll do it when I'm setting the question paper for you. That assurance you have from me. In other words, the question paper that we set, we from my side, we'll always try to be fair and synchronize it with the abilities and with the background of the participants who are in the course. But you're at the National Law School. We expect a certain level of commitment, hard work, and sincerity from you, which you will have to come to. Others, what's the point of coming to NLS? You can go somewhere else, right? The reason you come here, the reason you're being taught here, and reason you and I are talking to each other today is because we want to benefit from the NLS system of learning and teaching. And that's, if you can't do that, if you're not able to benefit from that, then the point of the course would be lost. That's where we are. Okay. Please keep in touch with me. I'm not trying to get away from these questions. As you know, I'm equally interested in the fact that you should do well in this course. But please be mindful of the things that I have just now stated. I have seen your comments, and I have also talked to people who just spoke with me right now, and I will relay them to the base people. Okay, shall we go ahead then? So we have in the next half now, we have something really interesting coming up, which is that we have been focusing on corporations and how income from corporations are being taxed twice and all those issues that come up with it. But corporations are not the only form of business organization, right? We have other forms of business organization, and those may be taxed not only differently but also in ways that we haven't yet addressed, right? So let me give you a simple example. Let me start with an example, and then I'm going to ask you to kind of talk more about what we're doing here, right? Here's something that I'm going to ask you. um, how do we tax? Say we don't focus on corporations anymore, right? We focus on something else entirely. We say we talk about charitable organizations, for example, right? And we focus on that. How are charitable trusts taxed? Right? Just to take one example, right? How are charitable trusts taxed? And you will notice immediately that there are some very interesting elements to that. Let me just share my screen because I was just going to tell you how they're taxed. Yeah, yeah. Let's just take an example. Taxation of charitable trusts, right? Not all trusts, charitable trusts. How are they taxed? Just to give an example, just to kind of um, get us going on this, right? And then I'll come back to the difference between trusts and partnerships and corporations more generally. But let's just start with this, right? How are charitable trusts taxed? And you will see in the case of charitable trusts, now I'm afraid you will have to go back to your act. You will see that charitable trusts are taxed under Section 11. So please go back to your act, either online or in hard copy, and you will see that Section 11 says income from property held for charitable or religious purposes. Section 11, Clause 1, subject to the provisions of Section 60 to 63, and don't worry about those sections, the following income shall not be included in the total income of the previous year of the person receipt of income. And the clause A is the most important. It says income derived from property held under trust wholly for charitable or religious purposes to the extent to which such income is applied to such purposes in India, and where any such income is accumulated or set apart for application of such purposes in India, to the extent to which the income so accumulated or set apart is not in excess of 15% of the income from such property. We learn two things here. One is if somebody is involved in what is called charitable or religious purposes, then that income is exempt even if some of that income is then set aside and even that income is exempt as long as it's up to 15% of that income. What is charitable or religious purpose? That you will see in in the definitional section. You will notice that the definitional section 2 clause 15 says charitable purpose includes, this is, I'm reading out section 2, clause 15. Charitable purpose includes relief of the poor, education, yoga, medical relief, preservation of environment, including watersheds, forests, and wildlife, and preservation of monuments or places or objects of artistic or historical interest, and the advancement of any other object of general public utility, provided that the advancement of any other object of general public utility shall not be a charitable purpose if it involves the carrying on of any activity in the nature of trade, commerce, or business, or any activity of rendering any service in relation to any trade, commerce, or business for a cess or a fee or any other consideration, irrespective of the nature or use or application or retention of the income from such activity, unless such activity is undertaken in the course of actual carrying out of such advancement of any other object of general public utility, and the aggregate receipts from such activity or activities during the previous year do not exceed 20% of the total receipts of the trust or institution undertaking such activity or activities of the previous year. Very interesting definition, lots of complications. Generally, charitable trusts are excluded from income. Many education institutions, NLS included, are charitable trusts. We are excluded. Our income would be excluded from income tax under Section 11. What is charitable purpose? You can see it's been defined, including education, but there are two constraints here. One constraint is that it should not involve carrying on of any nature of trade, commerce, or business beyond 20% of the total receipts. And secondly, that if you accumulate your earnings, it should not be more than 50% of the income, as mentioned in Section 11. Section 11 says uh, that if this is accumulated, if the income is accumulated, then that accumulation should not be in excess of 15% of the income from such property. So you notice that there is a we talked about forms of business, but when it comes to charitable trusts, there is it's a specific exemption in Section 11, and the definitional part of it is found in Section 2, Clause 15. And there are broadly two kind of restrictions. One is that the income can't be accumulated beyond 15% of the income, and secondly, if there's any trade or commerce in relation to this charitable, in relation to what the charitable trust is doing, then that can't exceed 20% of the total receipts of that trust or institution, right? So interesting definition, interesting way of putting it. Um, you have, and then if you see later on if you take a look at the Income Tax Act, you will see later on that Section 12A of the Income Tax Act talks about certain procedural formalities, including registration that needs to be done. And Section 13 excludes certain trusts from the exemptions given to charitable trusts. So you have Section 11, which is the general rule, read with Section 2, Clause 15, and then you have Section 12A, which deals with procedural formalities, registration, and then you have Section 13, which excludes certain trusts from the exemptions given to charitable trusts. Right. So that I just wanted to give you this example or this idea to show you um, how there can be a form of organization or a form of organizing behavior which is different and which is taxed differently, right? That's just an example of what I was telling you, right? And I gave you examples of how charitable trusts are taxed. Now, if you notice, that is just, I mean, I just wanted to feed you that information because I wanted to show you an example, but we have still not come to the general question because there can be both charitable trusts and private trusts. So we haven't come to a general question, which I think will be of interest to everybody, all the students here in this class, which is um, trusts and partnerships, right? Why should we choose trusts or partnerships, and why should we choose a corporate form? Right? Why are we choosing these different kind of things? In order to understand that, we of course have to understand the tax implications of choosing trusts and corporate form. And we say, well, in the case of corporate forms, there is double taxation, and we noticed how that double taxation has its own complications and issues. And I have said, although I have not showed you yet clearly, that in the case of trusts and partnerships, there's only one level of taxation and not two levels of taxation. I'll come to the particularities of it in a second. But before I do that, I want the class to tell me a little bit about, just as a business point of view, and of course, you can also talk about taxes. But just as a business point of view, why should we choose one form or the other? Right? I've titled this as trust versus partnerships, but it's actually a broader question. Why do we choose trusts? Why do we choose partnerships? Why do we choose corporate form? Right? I want you to spend, again, don't Google this. Just jot down on a piece of paper. I'll give you 5 minutes. Just jot down on a piece of paper what you believe are the reasons why somebody would choose a trust or somebody would choose a partnership or somebody would choose a company to do business. What are the reasons? And if you have some more points about how that dovetails or interacts or engages with tax, that's even better. But if you can answer the basic question first, why would you choose a certain business form? For what reason? That will be something that I will find interesting. Yeah, so 5 minutes, jot down your points, and I'm going to come back and I want to ask you that question. All right. Yes, please. So I have some answers already. Thank you very much for both Asha and Indu. Asha said that certain. Just give me a second. Sorry, second, please. Asha said that regulatory guidelines differ for partnerships and for tax, for trusts and for companies. Indu is saying that public disclosures, operational ease, lower cost of compliance makes trust partnerships preferable to company structure. Asha has added that also the manner in which the group of persons would like to make their presence felt before the larger public. That's right. Generally speaking, these are all relevant elements, and can I just add to that a little bit, please? First of all, um, the idea about partnerships and trusts is that they can be managed. Both the management and the ownership is generally in the same hands, and they can manage a smaller business better. It's only when they have to grow and when they have to go public that the question of corporate form comes into being. Remember that in order to go public, you need to be a company first. You have to be a private company in order to go public and become a public company, and so there are those considerations when we are talking about the difference in business form between these three entities. Lower cost of compliance is very important. Companies have to file various statutory forms every year, and that kind of statutory compliance is lesser for partnerships and for trusts. Having said all of these things, uh, it's important, and of course, nobody has mentioned that here, but the most important thing people say sometimes is the idea that of liability, that in partnerships, certainly I can't talk about trust for the time being, but partnerships, at least in theory, if it's a general partnership, every partner is liable for the debts, and whereas in a company, it's of limited liability. Now, of course, we have a special thing called limited liability partnerships, where you have a partnership, but every partner is every single partner in that partnership is liable only to the extent of his or her contribution to the partner, to the partnership. So that's about liability, which is an important point. Although having said that, there are various. You must all of you have got some practical experience or the other. So you must have gone to the bank to take a loan. And remember, even in the case of many private companies, the banks insist that the promoters give a personal guarantee and therefore for the loans, and therefore there is some liability there of the promoters beyond the limited liability they have through their company. So those practicalities you must of course keep in mind when we're talking about the liability issue between these forms, right? That's something you must keep in mind. Having said that, what about the difference between partnerships and trusts? That's something that we must think about, and uh, and I think that I think that distinction is sometimes not really mentioned well. Partnerships are usually there for commercial reasons and purely commercial reasons. Trust, as we have already seen, could be there for reasons other than commercial reasons. There could be a charitable reason, there could be a religious reason, and in many cases, there could be family reasons. Somebody wants to make sure that some family members are given a certain amount of money or assets, and that is protected. And so it is for their benefit that the trust is done and created. Remember, every trust has three parties. There's a settler who transfers assets or money to the trust. There is a trustee that manages that asset or money, and there is a beneficiary, which is the person for whose benefit the trust has been created. And therefore, trusts, unlike partnerships, are mainly meant for these kind of family purposes at the private level and charitable and religious purposes at the public level. And therefore, there's that difference between trusts and partnerships. Right. Now, let me see. I can do something today that I haven't done before for you. Just give me 1 second. Let me organize myself a little bit. Just give me 1 second, please. Yeah, I think this can be done. Um, I'm going to share my screen and I'm going to take you to the note that I have prepared for on trusts and also a little bit on partnerships. I think that might be easier for all of us to then look at together and do. Yes. So here's the note. Um, you notice that I was talking about the various ways in which Note 31 talks about the problem of double taxation at the corporate level. And there are various ways in which I said there can be this double taxation. If you go through Note 31, you will notice the various ways that I've talked about. However, I come here and I say that double taxation can be avoided if the taxable unit is a partnership or an LLP. A partnership or a LLP will be taxed at a flat rate of 30%, not taking into account surcharges, cesses, etc. And the shares of partners in the total income of the partnership firm or LLP is exempt in the hands of the partners under Section 10(2)(a), read with Section 2, Clause 23. And you can read these sections on your own. But what's important here is there's only one tax which is at the level of the partnership. When the partnership earns profits, those profits are taxed in the hands of the partnership because the partnership has earned those profits at a flat rate of 30%. And the when the partnership then distributes those profits to its partners, the partners in the hands of the partners is no longer taxed because it's already been taxed in the hands of the partnership. And therefore, in the hands of the partners, it's exempt. And here you can see an example of how there is only a single level of taxation and not double taxation. Right? And this is regarding the taxation of partnerships or LLPs. Now, India has allowed for limited liability partnerships, and limited liability partnerships are also taxed in the same way as any other partnership. Please remember that under traditional partnership law, there has to be at least one general partner and several limited partners, but there has to be one general partner in a partnership. A general partner is somebody whose liability towards the creditors is unlimited. And but now because we have been allowed to create an LLP, the LLP puts together the advantages of both corporations and partners in the sense that you have every single partner of the LLP has limited liability, but the LLP will be taxed as a partnership and will be taxed only once and not twice. Right, so that's the question about partnerships and LLPs. But we saw the Ankitec case, but now I want you to go to note 33, which is about taxation of trusts. And here I'm not talking about charitable trusts. I'm talking about private trusts that are created for the benefit of family members, for example. So a trust is meant to ensure that a legal owner, a trustee, manages property on behalf of a beneficial owner, that is the beneficiary. Now, under the ITA section 161, the trustee is a representative assessee, which means, barring certain circumstances, a trustee will be taxed only in a representative capacity on behalf of the beneficiary. The trustee is being taxed as an agent of the beneficiary, right? A representative capacity means that the trustee will pay tax on behalf of the beneficiary. For purposes of the ITA, it is the beneficiary that is being taxed. However, it is the trustee that pays the tax on behalf of the beneficiary. right? Usually, the beneficiary's tax paid by the trustee will come out of the income earned by the trust. Since it's the beneficiary that is being taxed, the trustee has to figure out and pay to the revenue with respect to each beneficiary the beneficiary's share of the tax on the trust income, keeping in mind the proportionate interest of the beneficiary in the trust income and the kinds of income that is being generated by the trust property. That's capital gains, interest, business income. The trust income will receive pass through treatment, that is, the tax is paid only once. And this is when the trust property earns income for tax purposes, capital gains, dividends, business income, following which the trustee withholds the proportionate tax of the beneficiary and files the taxes with the government on behalf of the beneficiary. After this, whether the remaining income after tax stays with the trustee or is distributed to the beneficiaries, there is no further taxation in the hands of the beneficiary because the trustee has already paid the tax on behalf of the beneficiary. If the trust earns business income, it is taxed at the business income will be taxed at the maximum marginal rate, which is 30%. Please see the definition of the maximum marginal rate in section 2, clause 29, clause C. If the beneficiaries are not determined, if we don't know who the beneficiaries are, then the trust income will also be taxed at the maximum marginal rate of 30%. So you notice that we have two regimes. In addition to the corporate tax regime, we have a regime consisting of partnerships, we have a regime consisting of trusts. Both the regimes, interestingly, have only one level of taxation, but there are some subtle differences between how the trusts are taxed and how partnerships are taxed. In the case of partnership, the partnership is taxed at a flat rate of 30%, and then when the income then goes back to the partners, they're not taxed because of a certain provision, exemption provision in the Act. In the case of the trust, on the other hand, again, single level of tax, but the trustee is basically acting as the representative of the beneficiaries, and therefore, what the trustee is doing is doing the job of paying the tax, but the actual tax liability is that of the beneficiary, and therefore it is the beneficiary's slab and beneficiaries the situation the beneficiary is in, which will determine what kind of income tax the trustee will end up paying to the government, except in the case of business income, where, like partnerships, there's a flat tax of 30% plus whatever other surcharges that are there, right? That you notice now that we are face to face with, you know, basically different kinds of forms of business with attendant different kinds of tax liabilities. The main substantial important difference is that in the case of trusts and partnerships, we have only one level of taxation. And as I said, that trusts or of partnerships are of various types. But if it's a case of LLPs, then it's a limited liability partnership, which combines both limited liability and one level of tax. Trusts, on the other hand, are also of different types. There are charitable trusts, there are religious trusts, there are family trusts, and now recently, if you would have noticed, a lot of venture capital funds and real estate investment funds, they also are operating through a trust mechanism. And you would have noticed that when you saw the news in the various papers, right? So this is now I'm going to stop. I'm going to stop my. Sorry, I'm just going to stop sharing, and I'll come back to the class. And I just wanted to ask if the class has any questions or any comments or any other thing they wanted to talk about regarding the taxation of trusts and partnership. What you need to remember is that, unlike in the case of corporations, the whole tax planning and tax avoidance that have happened in the case of corporations is not really the case for trusts and partnerships because they're basically only one level of taxation, so they don't have those kind of tax avoidance issues. That they may have other issues, but they don't have those kind of tax avoidance issues in them. But it doesn't mean that every single person must only do a partnership or a trust when they're doing business. There are lots of very good business reasons why somebody would start a company. Easy limited liability, more number of members can be part of the company. um, you have the ability to raise money from the public, and you can also show the public that you're more transparent and regulated. So there could be many reasons why you might, despite the tax problems that companies face, the question of double taxation, there could be many strong business reasons um, why somebody would choose to do business through the company, right? So that's what I wanted to mention to you. Do we have any questions or comments on what has been stated so far, please? Okay, great. We are almost done with our time here. So thank you, everybody. Have a great weekend. I have noted down your concerns as well about assessments, and I'll pass it on to Pace. In the meantime, you get on with what you are going to do in this course, which is read all the materials that I've asked you to read, go through these lectures again, and get a good grip on what we are trying to do with the income tax principles. But in the meantime, have a great weekend, and hope to see you again after 2 weeks. Thank you.